and discuss market fundamentals. We have Niket Shah, CIO at Motilal Oswal Mutual Fund, joining in now to discuss the way forward for the markets as well. Niket, good morning. Thank you so much for joining in. Today we are seeing a bounce back, but this is coming after that fall that we saw over the last 2-3 trading sessions. What's your sense? Is there more pain left in the broader markets and the benchmarks as well?
Yeah, thanks for having me here. I think if you look at our September fact sheet, you would have seen probably the highest cash level ever that we've got. We were about 22% cash across most of our funds. And the reason was that it was quite difficult to get companies with reasonable amount of earnings growth of, say, roughly about 20-25%. Even getting 25% earnings growth for most of the companies across sectors was quite a tough task. So we are seeing slowdown across the space, across sectors. And hence, if you look at our portfolios, which were a 30-stock portfolio, is now moved on to 22-stock portfolio because we just have to be much more sharply positioned. Two things that we are seeing. One is on the macro side, we are seeing some slowdown. Government capex is down 18%. If you look at most of the other cases from the state side, state capex is also down about 8%. So I think the macro side of the market continues to remain quite weak. Corporate tax rate are in single digit. Electricity growth is back to 6-7% versus double digit in the past. And last but not the least, the personal tax growth, which looks like 24-25%, but if you strip off STT and capital gains, it's down to 8% on a apple-to-apple basis. So whether it's macro, and then if you look to company specific or corporate earnings, if you look at banks, broadly roughly about 5-7% kind of a PAT growth for most of the companies. Large cap IT hasn't done extremely well. We are seeing again low single digit growth there. If you look at capital goods, which have been the darling of the street, we do believe a large part of the capital goods is really played out because a large order book win was in the last 2-3 years, and post that we have actually seen raw material prices coming down, and hence a large amount of benefit is because of margin led rather than top line led, which obviously is quite short lived, and we expect that to kind of reverse in the next 2 to 3 quarters. So I would say capital goods is pretty much towards the last leg of its rally, and hence the only sector then left is IT, telecom, consumer discretionary, NBFCs. I think these are the 4-5 spaces where we've kind of hidden ourselves. And within manufacturing also, some of the spaces like defense, where valuations have really caught up in the last few years. We are actually now moving back to wires and cables, where I think there is reasonable amount of visibility of growth. So it's a very, very narrow market. We expect market to be quite polarized. We anticipated that this quarter will be quite weak from an earnings growth standpoint, hence the high cash. But as things stand, we believe large part of that correction is played out. Maybe another 1 quarter of correction can be possible. There is expiry week and all of that. But fundamentally, we believe that a large part of the market participants aren't factoring in the US election. We believe if a favorable outcome of US election, which is on 5th of November, can really change the course of the market. And we do believe that we will still have a big year-end rally in November and December, and we hopefully will end the year with a lifetime high.
So you are looking to deploy the cash that you're sitting on, considering where, most of the correction is done, there is a year-end rally. And would you go back to your favorites, IT, telecom, consumer discretionary, NBFCs? Or are there new trends emerging or green shoots emerging?
I think the kind of pessimism which is there on the auto side, it's kind of been quite, a lot of stocks within the auto space have been beaten down quite sharply. So I think there is some value emerging there. So we would have looked at some of those spaces, but otherwise I think broadly sticking out to those sectors as such.
The other space that you like is telecom, Niket, and this is something that you've liked for some time now. Do you think there's still enough triggers left there? And what are those triggers that you're looking at? Because now there are a handful of participants in the listed space.
So I think, if you look at telecom, it's largely penetrated category. Volume growth is just barely 1 or 2% at best. But I think a lot of people aren't getting the fact that India needs to take a tariff hike every year. If the number 3rd player has to survive, there needs to be more tariff hikes. So I think our base case is that we will see a 15-20% tariff hike every year for the next 2 years from now. Probably it can be April, May, June, anyone's guess. But we expect a yearly hike of about 15-20%. And that really changes the cash flow economics for at least the number 2 player which is listed. And hopefully at some point of time, the number 1 player will also look at listing, which will obviously benefit some of the listed players as such.
Up until now, the tariff hikes taken by the telecom companies have been after a period of 2.5 years. But the converse argument, Niket, for this is that for a telecom hike to be absorbed, it takes 2 to 3 quarters till the entire pass-through happens. So therefore, to expect one immediately after in another quarter seems to be on the higher side, but that's the converse argument. Talk to us about technology. Now, large cap IT numbers were fine, in line, but there were no blockbuster numbers. But today we've got numbers from Coforge, Persistent, and they've blown the lights of the market. Stocks have reacted with a 10% up move. So mid cap versus large cap, and the next 1 year outlook for IT according to you, the thesis.
So I think we are broadly clear that large cap IT is going to struggle at least for the next 2 to 3 years. Given the size that they are at from a revenue standpoint, you will always see at best, low double-digit growth, assuming the environment completely turns around, right? So we have been in the mid-cap IT space, and you would have looked at our fact sheet. We are very, very large in some of the mid-cap ITs which have reported numbers yesterday. I think in the next 2 quarters, small-cap IT will start becoming quite interesting, and that's an area where we are continuously focusing at this point in time. We haven't done anything material, but I think it's kind of getting slightly more interesting from a valuation standpoint as well as from a growth bottoming out standpoint. So I would really look at small cap IT rather than large cap IT at least for the next 2 to 3 years.
Okay, so you look at small cap IT versus large cap IT. Niket, the other part of, we would say, the IT arena, if we extend it, it'll be digital services in general. Is this a space that you're looking at? We do have some of these platform companies. Are you liking anything there? Zomato reported numbers yesterday. There have been big deals brewing. Swiggy is coming up with an IPO. Are you still bullish after that run-up that we are seeing?
I think we need to consolidate, given the way valuations have really run up for some of these spaces. Having said that, I think in a 100-meter race, I think we've just completed 10% of it, right? So still 90% to go, in my opinion. And I think this is a very, very big value migration trend that we are seeing. Look at the traditional FMCG guy. If today there is a new brand which is wanting to launch a soap, for example, had no, in the past, he would get fearful because there was no distribution mode that he would have got as compared to some of the large listed companies. Today, he can actually go on some of the quick commerce guys, get themselves listed, and can immediately get that traction on board. So we clearly expect this value migration to continue. The SKU ranges that some of these quick commerce companies are going to launch, I think it's going to be quite wide-braced. Today, if you look at the square feet area, it's about 3,500 square feet for a dark store. I will not be surprised that in the next 3 to 4 years, we will have at least 10 to 20,000 square feet stores for some of these companies. And hence, this will become a one-stop solution for any customer to go for any product under the umbrella today. So I think this value migration is likely to continue. The kind of growth rates that we've seen from some of the quick commerce guys, I think will at least continue for the next 2 to 3 years. And the surprising part is that the tier 2, tier 3 markets continue to do far better than tier 1 markets, right? The break-even point is about 1,800 to 2,000 orders a day. And if you look at tier 2 markets are actually doing that in 1 month or 2 months versus a tier 1, which is taking about 4 to 6 months. So I think the tier 2, tier 3 is a big surprise here. I don't think anyone thought, including us, we never thought that tier 2, tier 3 will become so large. But I think now it's enough and more evidence that some of these businesses are actually made for pan-India rather than just tier 1 markets.
Yeah, so there's a big opportunity that's brewing in tier 2 and tier 3 cities. So Niket, in that case, would you look at these companies versus, say, traditional FMCG companies? DMart spoke about that big competition they're getting from QCom. So next 2 to 3 years, do you think there could be some persisting demand issues in the FMCG space?
That's pretty, we do expect some of that thing to clearly play out. But the other important part is that look at the FMCG trade channel. The regular trade channel, the regular mom and pop distribution channel that FMCG used to thrive on is under serious threat of survival right now. And in the next 2 to 3 years, if a large amount of traffic moves to quick commerce, I think some of the unit economics of the traditional channel will clearly get impacted. And that's, I think, something some of the listed companies have already called out. I think we do expect some of that to play out even further, at least in the next 1 or 2 years.
You spoke about NBFCs. In the NBFC category, what is it that you like? And are you worried about increased stress? Because, for instance, Bajaj Finance is also now talking about, the best of the breed, talking about an increase in the credit cost guidance. So how would you manage the stress? And also, if you have time, I wanted to squeeze in one more question on auto, but we'll get to that.
So I think within NBFCs, I think we are quite clear that we have to be very sharply positioned. I think the unsecured part of the market is quite scary. When we look at personal growth, personal loan growth, if you look at credit card growth, And then if you look at the consumption data, it doesn't add up, right? And it feels like a large part of that capital has moved to equity market. It feels like this. There's no evidence for that, but it feels like a large part of that channel has moved to capital markets. And hence, there is going to be stress in the unsecured side of the market, at least for the next 4 quarters, right? And hence, I think our clear focus has been that within NBFC, if any company has a large unsecured portion, we want to stay away from it. And hence, we would move more towards the secured guys within the NBFC space. Within the bank space, I think we are right now 0% weight on banks, which is quite unusual for us because there is just no earnings growth on the bank side, at least for the next 2 to 3 quarters. And I think if that has to change in the near future, we will relook at it. But at this point in time, we believe that most of the banks have squeezed out every line item possible, whether it's credit cost, whether it's NIM. And I think there are multiple headwinds going forward for the banking space, at least for the next 2 to 3 quarters point of view. While they're cheaper from a valuation standpoint, but they're cheaper because there's no growth. If the growth was 25-30%, I don't think they would be available at the valuation that they are.
Okay, and a quick word, where is value emerging in auto? You appear to say that the pessimism seems to have been overdone a bit.
So I think a large amount of pessimism around festive season was quite overdone. We haven't seen that kind of pessimism on the ground. There can be company-specific issues at all points of time, but we are seeing some green shoots on two-wheeler side on festive. We are seeing some green shoots on four-wheeler side on festive. Commercial vehicle continues to remain quite slow. So I think given the correction that we have seen in large two-wheeler and four-wheeler names, they might be interesting for a 15 to 20% rally.
All right, take that point, Niket. Thank you so much for joining in today. Always a pleasure speaking with you. That's the word coming in from Motilal Oswal. AMC, they expect the year to end with record highs on the Nifty as well. We'll slip into a short break.